Section 2 of Chapter 15 deals with a few more adjusting entries. We're going to adjust the merchandise inventory and the interest receivable accounts. 3 Green uses the periodic inventory method. During a fiscal period, all purchases of merchandise are recorded in the account called purchases. No changes in the amount of inventory resulting from purchases and sales are recorded in the merchandise inventory. As a result, the balance of merchandise inventory at the end of the fiscal period has not changed. The amount of inventory on hand at the beginning of the fiscal period is called the beginning inventory. During the period, merchandise is purchased and merchandise is sold. To determine how much merchandise remains in inventory at the end of the fiscal period, a physical inventory is conducted. The actual count of merchandise at the end of the fiscal period is called the ending inventory. A physical inventory is always conducted at the end of the fiscal year. Some businesses conduct physical inventories more frequently. The balance of merchandise inventory account at the end of the fiscal period must equal the actual ending inventory balance. Okay, now we're going to complete the work together as we summarize these adjustments. So let's go to your work together in your book on page 449. And you will need the work together papers that we used for section 1. We will also be using those in work together 2. Work together 15.2 says, use the general journal and the unadjusted trial balance from your work together. And we are going to complete these 2 adjustments. Number 1, from a physical count of merchandise inventory, the December 31st balance is determined to be $96,471.25. Journalize the adjusting entry for merchandise inventory. We're going to ask the 4 questions necessary for preparing our adjustments. First of all, it says, what is the balance of merchandise inventory? If we look at our unadjusted trial balance on page 427 of our working papers, you will see that the balance is $94,845.31. According to our book, the balance after they've done a physical inventory of all the merchandise at the end of the fiscal period, according to our book on page 449, we see that we have a balance of $96,471.25. You will notice that throughout the fiscal period, throughout the year, the merchandise inventory has gone up. So basically, you have purchased more inventory than you have actually sold. So again, our inventory is going to go up. We have a lot more in our inventory than it shows on our adjusted trial balance. Third step, what must be done to correct the account balance? We are going to increase our merchandise inventory with the difference, $1,625.94. What adjusting entries are going to be made? We're going to debit merchandise inventory. Remember, merchandise inventory is an asset. In order for it to increase, we have to debit it for the difference. And we are going to credit income summary for the same amount. Remember, most accounts needing adjustments at the end of the fiscal period have related expense accounts. And again, your expense accounts are temporary accounts. For example, when prepaid insurance is adjusted, insurance expense is a related expense account. Merchandise inventory, however, does not have a related expense account. Therefore, income summary, also a temporary account, is used to adjust merchandise inventory at the end of the fiscal period. Just remember, when an account that requires adjustment does not have a related expense account, the temporary account income summary is used. And again, income summary is that account that has no normal balance. It is just used for adjusting and closing entries. So to record this in our journal, you need to flip to page 429 in your working papers, and we'll continue on with that. We are going to write the date is the 31st. Merchandise inventory, we said, is going to go up, so we're going to debit merchandise inventory for the amount. and we will credit income summary for that same amount. Just a reminder also, if your merchandise inventory happens to go down throughout the fiscal period, the amount in merchandise inventory therefore would be credited to make that go down, and income summary would be debited. So it would be just the opposite if your merchandise inventory goes down at the end of the fiscal period. Moving on to the adjusting entries for interest receivable. Generally accepted accounting principles require that revenue be recorded in the same accounting period in which the revenue is earned. This is the concept realization of revenue. For a sale on account, revenue is earned on the day the goods are delivered to the customer. The sale increases the revenue account called sales, and it increases the asset accounts receivable. Unlike sales on account, some revenues are earned over time. For example, a $10,000 9% note receivable earns $2.50 of interest income every day the note is outstanding. You take 10,000 times 9% times 1 divided by 360 like we did last chapter. Making a journal entry for each day's interest income and the related receivable is impractical. However, the amount of interest earned must be recorded when financial statements are prepared. Revenue earned in one fiscal period but not received until a later fiscal period is called accrued revenue. A company must identify the period of time for which accrued revenue should be recorded. The number of days is used to calculate the amount of the adjusting entry. The adjusting entry for accrued revenue increases the revenue account, which is going to credit that account, and it increases a receivable account, which will debit that account. The income statement will then report all revenue earned for the fiscal period, even though some of the revenue has not been yet received. The balance sheet will report the assets, including the related receivables, which is your accounting concept adequate disclosure. At the end of the fiscal period, 3 Green examines the note receivable on hand. The amount of interest income earned but not yet collected is calculated. The interest owed to the business is an asset and is recorded in the interest receivable. Interest earned but not yet received is called accrued interest income. Interest earned on notes receivable is recorded in the interest income. Remember, interest receivable is an asset, thus the word receivable. Therefore, it has a normal debit balance. It'll increase on the debit side, decrease on the credit side. Interest income is the other source of income. It's not your main source, but it's another source of income. Your income or revenue is under the revenue classification. Therefore, it has a normal credit balance. It will increase on the credit side, decrease on the opposite side. Now on to analyzing the adjustments. You should turn your books to page 449 because we have the second part of the work together problem, and you will need your working papers to go along with it. So instruction number 2, a single notes receivable is outstanding on December 31st. The 90-day 8% note was signed on November 22nd. Journalize the adjusting entries for the interest receivable. Now on to answering the 4 questions. What is the balance in the interest receivable? If you look at your unadjusted trial balance on page 427 of your working papers, you will see that you have a balance of 0 in the interest receivable because we have not recorded anything yet this fiscal period. What should the balance be for the interest receivable? We need to take a look at the note and figure it out. $8,000 is the amount of our notes receivable, or the principal amount. The number of days into the note. The note was signed on November 22nd, so November 22nd till the end of the fiscal period, which is December 31st, that would be 39 days into the note. So we take our principal times interest rate times time as a fraction, and we come up with our accrued interest income. So $8,000 times the 8% times 39 out of 360 days, and we come up with $69.33, which represents our accrued interest income for those 39 days. What must be done to correct the account balance? We're going to increase interest receivable And we're also going to increase interest income by $69.33. What adjusting entries are going to be made? We're going to debit our interest receivable. It's an asset, so we must debit it to make it go up. And we're going to credit our interest income. Income is revenue. It has a normal credit balance. Since we want to increase interest income, we have to credit it. So to journalize it, we will go to the next line of our journal on page 429. We write the date of the 31st, debit to interest receivable, credit to our interest income. So again, this transaction represents how much interest we are going to receive during this portion of the fiscal period. The note isn't due until the next fiscal period, but we need to record the amount or these 39 days in this fiscal period. Now we have completed section 2 of chapter 15. Your assignment is to complete application problem 15-2 on page 465 in your textbook. When you are done, submit this assignment 15-2 on Canvas, and what I need to see is page 429 of your working papers.